All right, we might get underway. Welcome, everybody. I'll just get the slides working. A moment. Sorry, just trying to move the screen on. There we go. Hi and welcome, everybody. Thanks for joining us for today's topic of conversation, exploring just what's happening out there in markets around the world. Sorry, just having some technical difficulties. Yeah, particularly in the wake of coronavirus and the impact that has had. For those of you who I haven't met before, I'm Ryan Dobbrick. I'm the Director and Principal Financial Planner at Liberum Financial. Today I'm joined by Dan Miles. He's the Managing Director and Co-Chief Investment Officer at Innova Asset Management. They're the research and investment house behind our investment offerings. If there's anyone well-versed in understanding what's going on out there, it's Dan. Dan's led Innova for a long time and is responsible for overall portfolio management of Innova's managed account portfolios. He also oversees the design and refinement of the company's quantitative modelling processes, which is based on Innova's unique approach to managing investment risk. You might have seen Dan on Sky Business News. He's an active contributor to media discussions on issues affecting the investment and advice industries. He's also co-written a number of research reports on portfolio construction and risk management, including in partnership with a global actuarial firm, Milliman. Interesting thing to note that I was talking to Dan about earlier, but Dan practices what he preaches. All of Dan's wealth outside of his home are invested in the portfolios he runs. So he truly has skin in the game. Also, any of the bonuses that go to their staff are also invested in the portfolios they run. So they have true belief in what they do. Thanks for joining us, Dan. Really keen to hear what's happening out there and how we can ensure our investments can weather what's on the horizon. Just before I hand over, just a little bit of housekeeping. Just going to keep the slide on. It should change in a moment, but anything that we talk about today obviously doesn't consider your personal circumstances. It's general in nature. I do invite you to reach out to me afterwards if you'd like to chat about your situation specifically. I'll share my contact details at the end. There we go. Next slide. Also today, I'd like to encourage you to ask any questions through the session by using the Q&A feature. You'll see a Q&A icon down in the bottom of your Zoom window. I'll keep an eye on those and answer as many questions during the session. If we can't get to all of them, we'll have some time at the end. Shortly after the session, we'll email you a recording, which you're welcome to share with others that you think might be interested. On that note, I'll hand over to Dan.
Thank you very much, Ryan. Let me just set a stopwatch so I don't run over time and make sure that I can change these slides. No, it hasn't handed over to me yet. While it's handing over, yeah, thank you very much for that introduction, Ryan. We've actually got a very unique bonus structure in Innova. When we set up the business, I believe it was the first in the country we are the first in the country to have done this, whereby any bonuses that are paid out to staff, only 1/3 is available as cash and 2/3 are actually locked up and have to, by mandate, be invested in the portfolios that we run on behalf of clients. So not only have I put all my superannuation and any excess net wealth that I've got into the portfolios that I run, but my bonuses are invested in them as well. And whilst we can't mandate where staff invest their super, all of their bonuses are invested in the portfolios as well. So we really do, we don't just eat our own cooking, we eat it twice. So if we get something wrong, we hurt as badly as our clients do. So we take portfolio construction very seriously, and we genuinely run the portfolios in the way that we think is the absolute best way that they should be run, which I unfortunately cannot say about all my competitors. And I believe it's a fairly, there's been about 2 or 3 other fund managers who have copied our bonus structure, but I believe we were the first in the country to do it. I've got the obligatory disclaimer there. As Ryan said, everything is general in nature. If you need personal advice, please contact Ryan, as I am not qualified to give it to you. It would be very difficult not to start a market update without talking about COVID-19, right? How could you do that? How could you start without this? I'm not going to tell you anything you don't already know. It's decimated various industries across the global economy and the domestic economy, in particular hospitality and travel industries, other industries, anywhere that requires imports or cross-border interaction has been impacted in some way, shape, or form. Clearly, the retail sector has been turned on its head, and within the property sector, commercial office has been adversely affected as businesses have allowed and realised that their staff are more than capable of working from home without a reduction in productivity, and so therefore they are reducing the office space that they believed in the past that they would necessarily need. This has driven us into a global recession. Now, I've put up here US, the European Union, and Australian annual GDP growth numbers. This is the worst. This is not the worst depression we've ever seen. It's certainly not the great. It's certainly not 1929 to 1932 and then extended out to 37. It's certainly not the Great Depression, but over the period of time in which this enormous reversal in GDP growth towards negative numbers has occurred, this has been the most violent when annualized in recorded history. It has been quite astonishing how much it has wiped out in terms of overall productivity around the world across the majority of sectors. You've seen the unemployment numbers around the globe. I don't really need to labour the point. And the obvious flow-on effect to that is businesses are less profitable. If you own equity investments, if you own stocks, you own the right to the future earnings and earnings growth of those businesses. And if they are called into question because of something such as, COVID-19 and the lockdowns for COVID-19 and the subsequent negative effects that flow on from that, that's it's worthwhile having a think about when it comes to portfolio construction and where to place your assets. The strange thing is that it seems that nobody's bothered telling some of the biggest markets in the world that we're in a recession. The biggest bond markets in the world are the US Treasury market, the Japanese government bond market, and the European bond market. Those markets are traditionally considered what you would call defensive assets. And the reason I put that in inverted commas is because I'm not quite sure what they're defensive against. For the last 30 to 40 years, they've been defensive against equity market sell-offs, but they haven't necessarily been defensive against inflation and therefore the purchasing power of your capital. And right now, the US 10-year Treasury note is paying about a 70 basis point yield, which is not particularly attractive, but is light years ahead of the Japanese government bond 10-year, which is paying essentially nothing, or the German Bund, which is negative 0.5% or 50 basis points. At the same time, you've got the US equity market, which is at or near all-time highs all over again. And if we look at a valuation metric, I've got here something that's called there's a very famous valuation metric. Most people have heard of the price to earnings ratio, or a lot of people have heard of the price to earnings ratio. If you do a finance degree or you log on to the ASX.com, it will quote the price to earnings ratio for stocks. Robert Shiller developed a version of this where he took 10-year earnings as an average so he could smooth out the cycles. And then he put price to that average and looked at it all the way back to 1880 for the S&P 500. And then he upgraded that to account for share buybacks, dividends, etc., with a gentleman by the name of Bund, and it's now called the Bund-Shiller CAPE, and CAPE stands for cyclically adjusted price earnings ratio. Unfortunately, the only time we've seen valuations such as this were prior to the Great Depression and prior to the tech wreck. We're not quite at those levels, but we're certainly well above where we were in the GFC and in the boom times of the mid-60s. So somebody hasn't bothered telling the US equity market that they're in a recession, which is somewhat worrying. It seems to be that there's an enormous disconnect in some parts of the world between Wall Street and Main Street. Now, that disconnect would be fine if the outlook was fairly certain. If things were, if you could be, you could have a quite, you could apply a high probability to events occurring, but that is not the case. In my opinion, we are dealing with, whilst we are always dealing with uncertainty, we are dealing with a higher level of uncertainty right now than we have historically. If you go back 12 months ago to October 2019, you know, equity markets are around the same level, if not slightly higher than they were in October of 2019. And yet you've got far more earnings uncertainty on the corporate side. You've got far more economic uncertainty, as we saw with the budget the other night, and the stimulatory packages that need to be rolled out to try to stem some of the negative economic effects. We've got COVID lockdown uncertainty. So we know about COVID uncertainty, but the reality is it's not COVID that's the problem. It's the locking down of economies that cause the freezing up and ceasing of trade and buying of goods and services. So we've got COVID lockdown uncertainty, and we have trade uncertainty, in particular between the US and China, but also COVID has raised question marks in regards to supply chains where businesses relied on one individual supplier for their goods because they could use their spending power to drive down the price, and yet COVID would highlighted the risk in that strategy, in that they were not able to get access to the inventory that they needed to be able to run their business, and they needed to diversify those supply bases. But there is uncertainty as to whether one, that could be done, or two, that whether manufacturing capacity to be able to facilitate that needs to be brought on board in countries around the world. And then finally, we've got the 2020 US election. And I really don't envy the American citizens. I actually quite feel for them. 2016 saw an election between a reality TV star and somebody who probably should have gone to jail for utilizing a philanthropic trust, tax-free philanthropic trust, in an inappropriate and illegal manner. And now in 2020, you've got that same reality TV star who is now 73 years of age and doesn't look like he's necessarily looked after his health, competing against someone, I believe Joe Biden is 78, or was he 77? I can't remember if Bernie Sanders was 78 or 70. Anyway, one of them was 78 and one was 77. Not that being 78 is a bad thing. In fact, you know, the older you are, the more knowledge you accumulate, right? The more wisdom you accumulate. However, there is for my sins, I have a biological background as well as a finance background, and spent a lot of time studying the sciences. And there is a phenomenon called cognitive decline, which people generally believe and have documented occurs from around about the age of 30 through to death. And so at the age of 78, the general wisdom is that someone at the age of 78 does not have the same cognitive abilities as someone at the age of 30. So i.e. they are not able to deal with high pressure, complex decision making, as well as somebody in their 30s. Now, in reality, cognitive decline can be staved off through diet, lifestyle, supplementation of various things, but the sciences in regards to that have only been out for the last 6 years or so. So it's very unlikely that Joe Biden has been exposed to that or has been told about that, and it's very unlikely that he has partaken in those sorts of activities that are required to promote brain-derived neurotrophic factors, or BDNFs, if you're familiar with the neuroscience, and neurogenesis. And so he is applying for what is quite possibly the most stressful, highly complex job in the world, at a time that he may not necessarily have the cognitive ability to be able to perform to the best of his, to the best that he has been able to historically. Finally, there's we're going to be dealing with something called the red mirage. For those of you who don't know what the red mirage is, you are undoubtedly familiar with the fact that Republicans, who are, hence the red, have made no bones about the fact that they, in support of Trump, refuse to wear face masks and make a point of showing that, if you wear a face mask, you're a Democrat, and if you wear a face mask, you're a Republican. If you don't wear a face mask, you're a Democrat. But also that they will actually be going to the polling booth and are going to flagrantly ignore social distancing and congregate in highly populated areas. The Democrats are doing the complete opposite. And so there will be a large proportion of Biden supporters who will be mailing their votes in. Therefore, on election day, the votes that are tallied initially may show Trump as ahead, or not winning, because not all the votes are in, but ahead. And then when all those votes have been counted, but not all the mailing votes have been received, Trump may claim victory. That is the red mirage, in that the mirage being that there may be a wave of postal votes that are yet to come in, and they may actually show that Biden actually has achieved the majority. And both parties have said that they will not accept the result of the election and will be taking it to the Supreme Court. So it's going to be very interesting to see how that plays out. But the thing that concerns me, and the thing that I think investors need to be cognizant of, is that this level of uncertainty, when things are uncertain, you should factor that into the amount you're prepared to pay for an asset. And it doesn't really matter what the asset is. Like, we're talking about financial markets at the moment, but it could be a residential house, or it could be you're looking at making an investment in your own business, or you're looking at funding your children to start up their own small business, or whatever the case may be. If there's any level of uncertainty, you don't want to pay as much as you would if it is a sure bet, right? And right now, things are highly uncertain. And if things are highly uncertain, then you don't want to be paying through the nose for assets, because the forecast level of return on those assets is lower. In fact, if I go back to here, the turquoise line on the top, which shows with the little black circle on the right-hand side that puts it as expensive, every time the market has been above that, the subsequent 10-year returns have been very paltry, have been very unimpressive. And so it just shows that you don't want to overpay for assets, particularly when you're in a period of heightened uncertainty. Now, because we are in this very unique scenario that we genuinely have not seen before, which is central banks buying every debt instrument that isn't bolted to the ground, cash rates at or near zero in most places around the world, and equity markets at a premium, and therefore their forecast level of return being lower, as I said, more and more investors, institutional investors, large pension funds, etc., are moving out the risk curve. And by moving out the risk curve, that means they're taking on more risk to try and generate more return or more yield. And I've got a chart here of what is called the spread of high yield bonds, and I'll explain what that is. Spread is the difference between the yield you receive on this basket of bonds minus the yield that you would get on a basket of equivalent US Treasury bonds, because they're considered risk-free. And the difference is what they call the spread. And you can see there that the spread is around about 5%. And whilst it's not as low as it was pre-GFC, or let me just move this little thing here, or as low as it was in 2018, we're still looking at 2013 levels, 2011 levels, we're looking at 2003, 2004 levels. We're looking at levels that occurred in a fairly benign economic environment, and we are in anything but a fairly benign economic environment. So the high yield bonds are otherwise known as junk bonds. They are the riskiest bonds you can possibly buy in the marketplace. And in the capital structure of a business, so who gets paid first in the event that something goes wrong, they are the second last people to get paid. The last people to get paid are the equity holders. The second last are the junk bond holders. They are the most subordinate to everybody else. And so you should be paid a premium for owning those. And the premium is the spread. And if you look at that spread, I don't believe that that spread at 5% accurately reflects the amount of risk and uncertainty that is in the marketplace right now, because people are moving out the risk spectrum because they are getting nothing on cash, they're getting nothing on term deposits, they're getting nothing on sovereign bonds, whether they're treasuries, Japanese government bonds or Euro bonds. And so they're buying these higher risk instruments to try and generate a return, which I don't think is necessary, and I don't think is necessarily a good idea, because if things go south, it could go south in a pretty unattractive, and it could be quite bad. So what have we done in portfolios? Pardon me. Why is this not done? There we go. So what are we proponents of? Well, first of all, we recognize that going forward, returns are going to be lower than they have been historically, unless there's one caveat, unless we enter a period where both fiscal and monetary stimulus is essentially unending, i.e. you could run budget deficits of 10, 12, 15, 20% into infinitum. And the Reserve Bank of Australia, or the Federal Reserve Bank of the US, or the ECB over in Europe, or the Bank of Japan over in Japan, or the central bank of your region is prepared to continuously buy those bonds. That process is referred to as modern monetary theory. If that is embarked upon and we don't see any form of inflation picking up, and inflation expectations don't pick up, you could see equity markets run away from here and do really, really well from here. We've seen it before. There are two instances that stand out. Everybody is really aware of the tech bubble. So if I look back at the Schiller PE during the tech bubble, for the US, in the last 140 years, that is the most expensive it ever got to. It got to almost 50 on a CAPE basis, on a cyclically adjusted price earnings basis. But things can actually get even more extreme than that. If you go back to 1989 and think about Japan, when everybody thought that Japan was going to be taking over the world, on a CAPE basis or a Schiller PE basis, the Japanese equity market, the Nikkei 225, got up to roughly 100. So double what the tech bubble was. So there is the chance that that could occur. However, I would put that at a very, very low probability of occurring. I cannot see how excessive spending does not lead to some form of inflation and paltry returns, and a requirement for to pay back, or at least show that you can pay back the debt that you have issued, because debt holders at some point will just say, look, enough is enough. I don't think that you're going to be able to pay back your debt. I'm out of here. And the only way they can get out of that is something called a debt jubilee, which if people are interested in, I can talk about, but it gets a little bit complex if we start talking about debt jubilees. Oh, pardon me, my phone was ringing. I thought I had it on silent. Just bear with me for a second, I apologise. So what do Innova's positioning? We recognise that we think that is a low probability of occurring. We think what is more probable is a series of other outcomes, and in all of those outcomes, returns are going to be lower going forward because the price you're paying is higher. I mean, it's no more complex than, if bonds are paying between 0 and 1% and equities are the most expensive they've ever been in the US and they're close in most of the rest of the world. Well, you can't expect 20+% type returns from equities, and you can't expect more than, say, 1% from bonds. So you're going to get lower returns. But to maximize the return, we don't think that going up the risk curve is necessarily required. We don't think you have to do that. We think that you can get reasonable levels of return, satisfactory levels of return. They admittedly will not be as high as they have been historically, but they will be high enough that that people will be able to achieve their goals, and you can manage risk inside that environment so that you don't have excessively large drawdowns that can unnerve people and force them to go to cash or destroy them when they're in pension phase because they've had to draw their money out and spend it, if by doing certain things and being active about your asset allocation. And these are the things we are doing right now. In 6 months' time, they could be slightly different, but this is what we're doing right now. We are investing in equity markets that display either greater growth, they're on a better valuation multiple, so a lower valuation multiple. So they would have been, on that chart that I showed you, they would have been lower down towards that average band, preferably below that average band if possible, or ideally both. And there are a few markets around the world where they are actually both. And unfortunately, they come with the highest level of risk. So we have to risk weight the amount that we can allocate to those areas. But they are places that we have invested in. They are the places that we are most attracted to. We've also invested in a particular style of equities called value equities. Now, that may mean nothing to you, but it basically means buying cheap stocks. The reason we've done that is that the value style over 150 years has proven to be the best way to invest in equities if you just wanted to follow a style and not pick stocks and just follow something relatively simple and just invest. But it has underperformed for the last 9 years. It has been the worst place to invest over the last 9 years. We don't think that that will continue, but if we're wrong, we've barbelled it with what we call quality stocks. So stocks that are characterized, oh, sorry, the light of my fish tank just turned on. The value equities are classified as those that are made up of companies that have stable and growing earnings per share and return on investment and low debt, essentially. We're buying sovereign bonds that are paying a real yield. What a real yield is a yield that is positive after taking away inflation. Because it's, if you buy a 10-year US Treasury for 70 basis points, if inflation is negative 0.3%, well, your actual real return is 1% per annum. That's, it's not good, but it's at least it's positive. But if inflation is 1% per annum, you will actually be the purchasing power of your capital will be degrading by 0.3% per annum every year, because you've got a negative real yield, even though your nominal yield is positive. So we're concentrating on sovereign bonds that pay a real yield. We're aware and cognizant of the fact that if inflation feeds through, it doesn't matter if sovereign bonds are paying a real yield, they will get hurt because they pay a fixed coupon, and fixed coupons do not do well in a rising inflation expectations environment. So we are concentrating on floating rate bonds as well, but floating rate bonds, you generally cannot buy government floating rate bonds. You need to buy corporate floating rate bonds. So we are sticking to the very well-rated senior secured bonds, and we also particularly like senior secured loans, which obviously are all in the investment grade space. about a month ago, we invested back in domestic listed property with a very big underweight to the retail and office sectors for the reasons that I outlined earlier. And we have a holding in precious metals just in case inflation comes back, but interest rates don't actually go up because central banks can't raise rates. What we are not investing in, or we had tilted away from and reduced our exposure to.
Hey Dan, I might interrupt you there. I had a question from the audience about, while we're on precious metals, what's your view of the likely way for gold now with all the uncertainty out there? What do you think this scenario is? It's
a really good question. I wish gold was still 1,300 because I would own 3 times as much of it. People think of gold in lots of different ways. We consider it a currency. For the last 5 millennia, it has been a currency. So we look at it as a currency. We look at it as a way of maintaining your purchasing power. We don't think it is solely an inflation hedge, which a lot of people think. They think because of what happened in the 70s, gold spiked when the oil price spiked and inflation went up, that gold's an inflation hedge. In reality, if you actually look at 5,000 years worth of data and information, which is hard because the records are not good, but if you do the research, you can get a reasonably good picture. Gold is a good hedge against uncertainty, which is exactly what you said the client, the listener has, or the viewer has asked. So given the level of uncertainty that's out there, I probably could not paint a better picture in terms of fundamentals for gold right now. I don't think there has been a time in our recorded history where the scene is set for gold that is more positive. The only caveat to that is it's 1,900 bucks. And I said earlier, everything is dependent on the price you pay, which is why I would love for it to fall down. I don't, to be honest, with this much uncertainty, there's no way it's going to 1,300 bucks. I really don't think so. But if it gets to 1,400 bucks, which is very unlikely, I would load up. If it gets to 1,700 bucks, we would probably top up. So because I think there is a high probability that it has a lot further to run, and I think there is a low probability that it will do poorly from here. But you know, the scenario in which it would do badly is not a zero probability event.
Yeah. No, thanks, Dan. That's great.
So the things that we've either removed completely from portfolios or we've reduced our exposure to because we think they're unattractive, but we hold them there just in case we're wrong. Growth equities, so they're kind of the opposite of value equities. So think of companies like Netflix or Afterpay or even CSL here in Australia. CSL is a quality company, but it's also a growth company. And US equities in general. So the US equities that we own are specifically focused on quality and value. So we're not, with value, we're not paying the same sort of multiple as that. Which way is the chart looking for you guys? Is it that way or is it that way? That way. So we're not paying the same sort of multiple as that Schiller PE that I showed you. We're not paying the same sort of valuation multiple, but we also have probably about 20% of our international equity exposure in the US, whereas the index is 60% US. So we only own about 1/3 what the index does, or all our competitors do. So it's a pretty big call. And within those equities, they're either quality equities or they're value equities. We don't own any negative yielding sovereign bonds. Like buying a 10-year German Bund that'll pay you, that you need to pay them, or actually you don't actually have to pay them, but the value of your capital will erode by 0.5% a year for the next 10 years does not sound like a good idea to me in any way, shape or form, and no one can convince me otherwise. We haven't bought any sub-investment grade bonds. So that's that high yield chart that I showed earlier, the high yield bonds that I think are not paying a sufficient enough spread because too many people have moved out the risk curve. And because they're very, very high risk. The only reason they have that really, the only reason they haven't blown up is because the Federal Reserve has illegally backstopped them and paid BlackRock or hired BlackRock to buy them on their behalf. And then finally, in listed property, we have reduced our exposure domestically and largely eliminated our exposure globally to retail and office. And I think if you do that in a portfolio today, you can be fairly confident that you'll get whilst you won't get the same returns as those in the past, you'll actually do pretty well. You'll do reasonably well without taking on excess risk. If you wanted to take on excess risk, you could, but I actually don't think you're guaranteed to get a higher level of return unless you wait 30 years. And I don't know any clients that are prepared to, give me 30 years and give me their money and then not come back until 2050. So I don't manage money that way. And on that, we're at the 31-minute mark, so bang on.
I've got a couple of questions. If anybody's got any questions, yeah, feel free to hit that Q&A button down the bottom. I have a couple that come to mind that I get asked a bit. Obviously, with the budget this week, announcing big deficits now and into the future, people worry about what that means for our economy and our kids and things like that. What are your thoughts on going into that much debt as a country?
Budget deficits at the federal level, I hope I don't offend anyone when I say this, are not the same as running a budget in a household. If you print your own currency and the debt that the debt that the federal government owes is in your own currency, then you can actually run deficits forever if you want to. You don't actually ever need to pay them back, in theory. In practice, those deficits only really become a problem when the counterparty who you owe money to call into question your ability to pay them back. And that is usually preceded by the rating agencies downgrading you. So you would remember back in, when was it? August of 2013, when S&P downgraded the US to AA+ rating from AAA, and Australia up until 2 years ago, I think it was, had a negative we were AAA rated, but we had a negative outlook. That was then moved 2 years ago to a neutral outlook when we moved back to surplus, which everyone applauded the government for, but in reality, it was actually the iron ore price that brought us back into surplus. But so as long as the counterparties don't call you on your debts, you're okay. So the way I think it will actually roll out is that we are going into an enormous amount of deficit, but so is everybody else in the Western world, everybody else in the developed world. And so the rating agencies are not going to be penalizing us unless they penalize everybody, which I don't think they'll do because they look at everything on a relative standpoint. So the theory that you can run deficits forever will probably play out in this instance because they have been caused by a pandemic, not because there's an isolated incident where one country is running an absurd deficit because of fiscal largesse. So I'm not particularly concerned about it, and I think it's actually an appropriate measure. So I'm sorry if I offend anybody and they don't agree with me, but that's just my opinion.
Thanks, Dan. I had another question from the audience. So talking about gold, would you mind elaborating into other precious metals and your thoughts on that? I know earlier in the year in your portfolios you held silver, so maybe if you could talk a bit about that, it'd be great.
Silver and platinum both have industrial uses. Gold pretty much doesn't. If you look at the demand side of the equation for gold, there's a few main areas. People think central banks are the main buyers of gold. They're not. That's not true. The main buyers of gold are the jewelry market. The largest jewelry market in the world is India, and that makes up roughly 40% of gold demand globally. After that is investment, and in fact, it's investment that fluctuates. If you look at a chart that has like the areas of investment over time and how much they've got, the jewelry demand is relatively stable. The investment fluctuates all over the place, which is why the price swings, which means the investor is the marginal buyer. And then you've got central banks, that's a very minor component as well. But the demand for gold in the futures market also comes from the producers themselves. So that's gold. Silver is a different beast altogether in that there is, it is like a leveraged version of gold, but it also has industrial applications. I mean, silver's an antibiotic. I mean, if people are looking, if people are worried about, 5G radiation causing problems to their cellular structure, but you can actually buy shirts that are woven with silver to create a, what's the cage called? I can't remember the name of the cage. Anyway, to create a cage to prevent radiation from entering their body, and they're antibacterial to prevent, smell from sweat, etc. And you can buy band-aids with silver in them. So it's a little bit messier because it's not as clean as just, how much is the supply and what is the investment demand, because you also have this industrial use component. And the same can be said for platinum. But what we do is look at the gold to silver ratio. The reason why we bought silver earlier in the year is that the gold to silver ratio has fluctuated between 140 throughout time, and it got up to about 125. So that means that gold could buy 125 units of silver. When it's at that sort of level of extreme, given that it mean reverts means there's an average, and it always goes up then down, right? We bought it when it was here, hoping it would go here, and it did. So it got up to 125. We bought it. The gold price rallied, and the silver price rallied as well, but the silver price rallied a lot more than the gold price. And it closed that gold to silver ratio down to about 75 when we sold. And we made about 50% in 2 months, I think it was. And going forward, if the gold price drops to, if it drops to, say, that 1400 level, I probably wouldn't just load up on gold. I probably would buy a reasonable allocation to silver. Silver is far more volatile, but it's like getting a leveraged exposure to gold. And people don't like the word leverage, but I'm not actually borrowing anything. I'm just getting a leveraged exposure, which means I don't need to put down as much capital to get the same result. And I can put that capital to work elsewhere into something that might be far less volatile to get the same sort of level of outcome, as opposed to putting it all in gold, and get, on a risk-adjusted basis, get a better result for clients.
That's great. It doesn't look like we have any more questions. What I might do now, I just want to talk briefly about a portfolio that Innova runs, the Innova Lifestyle Preservation Portfolio, and why this is, I think, hot topic at the moment. Most days, talking to clients, a lot of people want to know what to do with cash. They say it's paying me nothing. And like Dan was saying, once you factor in inflation, you're actually losing money when you sit money in the bank. So the Innova Lifestyle Preservation Portfolio, it's the most conservative portfolio that Innova runs. So it's designed to fund goals that are short-term in nature. It's suited to those clients who have a more conservative risk profile and looking for a better return than cash can offer, and offers a real positive yield while controlling risk. And Dan, if you want to just elaborate a bit, but it recently, like just as of yesterday, you had a bunch of return figures come in of the whole of Australia running managed portfolios. And I don't want to steal your thunder, but you did amazingly well. You want to
it's a little embarrassing to talk about, actually. But it was quarter end, and our team decided to take a look at the performance of everybody in our category. So every multi-asset managed account available in Australia. And we looked at their performance over 3 years, 5 years, 7 years, 8 years. And it was very interesting. If you consider 3 years to be the relatively short term, we have the best performing managed account portfolio in the country. It's in the higher risk category. In the growth category, we have the best performing managed account in the country. In the more moderate kind of medium risk category, we have the second best performing portfolio in the country. In the moderately conservative region, we have the second best performing portfolio in the country. And in the conservative end of the spectrum, we have the best performing portfolio in the country. Over 7 years, we have the best performing portfolios across all categories, and we have them across all categories in over 8 years as well. But in my presentation, I talked about how I don't believe you need to take excess risk to be able to get return. You just need to be more proactive in your asset allocation and you know, really do the work. Like I think the days of just sitting back and being passive and just leaving your money into a 60% growth, 40% defensive portfolio, I think they are really going. There's a very high probability that they're going to have very tough times going forward. So we wanted to look at the risk in the portfolios, right? Because you don't want to just have great performance because you took on excess risk. And the best way to look at that was the drawdown during COVID. Unfortunately, we can't get the peak to trough. We can't get the intra-month data, but we got the performance for March. And if we go through each category, in the high growth category, our drawdown, one of our portfolios, so the portfolio that is the best performing over the short and long term in the country, also had the least drawdown. In the growth category, we're fourth best, so we're in the top handful. In the balance category, we have the least drawdown. In the moderately conservative, we have the least drawdown, and in the conservative category, we have the least, the second least, and the third least. And in fact, the first and second are the two portfolios that you are looking at right there, and they are the only two portfolios that I'm aware of that are multi-asset portfolios that can say that in March they lost less than 5% in the month. And the next closest that I can see is 2%, is just a little bit more than 2 percentage points worse than us, out to 6.5% worse than us. So our competitors performed between 2 and 6.5% worse than we did in the month of March in this conservative category compared to these two portfolios that you're looking at right here, which we're quite proud of, because it's one thing to get returns, but everyone can get a better return if you wait long enough and take enough risk. It's another thing to be able to do it without blowing up your client's capital or going through a period like COVID and actually protecting capital.
Well done, Dan. That leads to the end of the conversation today. I appreciate you all for listening in. If you got any more questions, don't hesitate to email or give me a call. For people I haven't met, the first time we get together is always complimentary. But thank you, Dan, for all your insights today, and thank you all for joining us.
Thank you, everyone, for listening and tuning in.
Thanks, guys. See you later.